Good morning, ladies and gentlemen. My name is Roger Scott, and welcome to our midweek roundtable. We have our usual co-host, 𝗧𝗴𝗀, my usual. I'm a troublemaker, so I'm going to put you in the troublemaker camp as well.
Always have been. Always have been. Nice to see you, Roger.
You too. So you're not. It's kind of interesting, just so everybody kind of knows where we're at. I'm not in my office, and you're not in your office, and it is July. You know, kind of putting two together. So you're at Hilton Head, right?
Yeah.
And I'm in 𝗧𝗴𝗀𝗃.
Nice. Where's that?
Yeah, it's just about an hour and a half north of Boston. It's a really pretty place, very scenic, but just not much to do, kind of spending time with the family and doing the usual summer stuff.
Great.
So what do you have to say for yourself? What are you thinking about the market? What are you seeing these days?
Listen, we had inflation numbers that came out yesterday that we haven't seen since 2008. We got this clown in Washington telling us, don't worry, it's going to hurt just a little bit for a little while, but it's going to be transitory. Like they tell you that right before they execute you at the end of mafia movies. Like it's only going to hurt a little bit. And don't worry, it's all be over soon. And, we had month over month, almost a full percent CPI. And that's without rent and or housing, shelter, which is like the major component of everything, which everybody knows has been exploding on the upside. And stock market did a little one of these who cares yesterday. And then at the end of the day, they had a bond auction at 2:00 and nobody showed up and the bonds sold off and the yields went up. Big shock. Nobody wanted to get 1.35 for a 10-year bond at the auction yesterday. And so with the inflation. And so market sold off, and then this morning we looked bid again. Earnings season. Companies are making money. I mean, you can't fight the fact that there are some companies that for whom this environment of easy credit, inflation be damned, consumer be damned, is a good thing.
Yeah, and the truth of the matter is, some of the companies, especially the financials, and I mean, it's a little early in the game. I mean, we should probably have
earnings season. Yeah, for sure.
Yeah, we're just getting warmed up. I mean, Goldman Sachs, Bank of America, and Pepsi, those three companies don't dictate, our economy.
Yeah.
So far the numbers have been pretty good, but as you and I have said, this is an interesting earnings period because companies are not, we're kind of not using the old COVID excuse anymore.
Right.
But you know what they are using now? They're using the old supply, the supply, the lack of supply chain trick now. They're going to be using excuses for as long as they possibly can. It's just the name of the game. But yeah, I do agree with you. Things are a little better. I'll tell you what's getting me really concerned. What's getting me really concerned is I'm seeing a big premium right now on the large caps, a huge premium, especially when you compare it to the mid caps and the small caps. And actually most sectors, if you take away the consumer discretionary, and if you take away the technology, not infotech, but regular tech, the XLK, you're gonna get a market that looks very, very different than what the S&P looks like right now. You're gonna get, I mean, if folks at home, if you want to see what the market really looks like, take a look at the MDY or IWM ticker symbol. That's the mid cap 400 or the Russell 2000.
I was just going to say IWM yesterday. S&P traded down 30 basis points. Nasdaq traded down 40 basis points at the close, and the IWM was down almost 2%. There were stocks getting taken out and just shot in the head yesterday. And if you just turn on CNBC, you say, nothing burger, not even a full percent, down 30 basis points. Who cares? 130. Yeah. But underneath the hood, the breath is terrible. It's so terrible. Sectors are getting whacked. A lot of stocks are breaking down underneath all the moving averages. Death crosses happening all over the place. But you have a couple of the big bad boys. The Apples, they're doing great. The stocks are up.
Yeah, I mean, have you seen
Amazon,
Apple? Just
it's an explosion.
Yeah. I mean, if you recall when we spoke last week, I mentioned to you that I did a spread on the equal weighted S&P versus the regular SPY.
Yeah.
I think 8 points my way it's gone so far.
Beautiful.
because the market is still it's just having a very, very hard time with that market capitalization. And the truth of the matter is, you're not going to have, and again, maybe I'm wrong, but you're not going to have 10 stocks dictating the stock market as opposed to the entire, it's just,
Those
it's a matter of,
stocks have become macro assets. They're like the 10-year note. They're so liquid, they're so massive, and it's like you either buy a 10-year bond or you buy some Apple, you buy some Google. Believe it or not. And so you can't really you can't deride what the entire market's doing from these macro assets. And one thing that's interesting to me is that we did see oil yesterday rip back up on this inflation stuff. Like, I think the reflation trade is going to come back with a vengeance this summer, because these guys are committed to keeping the pump on and telling us that it's transitory every month. I mean, we've been looking at month over month, at least 0.5% for like 5 months. And they've been saying transitory since March.
they have.
And we're sitting here in July. And so at a certain point, subjective, useless terms like transitory start to get more examined. And people are like, wait a second, like, yo, dad, do you know where you're going? We've been lost in the woods for 3 hours. And I'm like, listen, kid, I've been here before. But the truth is, I don't know where the hell I'm at. I'm looking at my iPhone. I got my watch. I got my compass out. And it's kind of the same thing with the Fed. This is uncharted territory. They don't know where they're at. They don't know what's coming. They don't know what's not coming. They don't really recognize the fact that, just making Amazon pump higher isn't necessarily good for the broader economy, might have a calamitous fallout. I don't know. That remains to be seen.
Wouldn't it be amazing if they went up there and said it just how you said it? This is uncharted territory. We have no idea what the hell we're doing.
Sometimes, Roger, I watch the United States Senate and I'm like, I got to run for a Senate seat. I just got to ask these guys some questions. Why aren't anybody asking the 800-pound gorilla questions? Like, do you really know what you're doing here? This has never happened before. What if this happens? What if that happens? Surely used cars going up 40% can't be a good thing. Surely rents going up 50% can't be a good thing. Don't you feel like being an average consumer in this country is a real misery job, right? A miserable experience right now? Why isn't anybody advocating for like normal Americans, like the middle class around the world? It pisses me off. But I mean, we're here to talk about stocks, so.
No, but
there's going to be,
it's all connected. It's all connected. Everything is connected. And you're absolutely right. I wish somebody would just come out and say, what the hell are you guys doing? Like, is there an adult here minding the shop? Because it just seems like everybody's passing the buck and putting their head in the sand right now. That's what it seems like to me. And I agree with you. Interestingly, you kind of started talking about interest rates and about the energy market, and you kind of backed off. I've been looking at the crude oil market last week. As a matter of fact, I've been looking at it for the last couple of months pretty intently because I know you've been talking 100. I know T-Buzz has been talking about 100. A lot of people have been talking about 100. So I looked at crude oil, the continuous contract, and we're literally right now sitting at a level, literally on a monthly chart. And folks at home, I highly encourage you to take a look at a monthly chart of crude oil. We're literally sitting at a resistance level. And if we just uptick a hair, literally a hair above, this thing doesn't have anything between 70 something and 100. This thing can really move.
I think that's going to be the story of the summer. I think it's the trade of the summer. I think we've been talking about these low-hanging fruit trades. We've been talking about oil stocks that have been, since oil was in the low 60s, crude oil was in the low 60s, stocks are 25% lower. These stocks are still 30% historically cheap compared to where they would be the last time oil was at $75 a share. I think oil is historically cheap if you factor in inflation and where everything else is in the last 15 years since oil's been at these levels. So I think there's a ways to go. I think we might get a sticker shock number and then come back down to earth. I think you might see a parabolic move in energy, and it might be the actual crisis tipping point. Because unlike housing, the price of steak, people like to use lumber, but nobody really gives a shit. I mean, how often do you buy lumber? Nobody's like, you don't build a house every day, right? But, when everybody goes to the gas station once a week, you can't hide from those numbers. And that's the sticker shock of that is gonna cause the crisis. It's gonna cause the public outrage. the political pressure, the screws are going to start to turn on the other side, and they're going to have to do something. They're going to have to. They're going to be forced. The problem is, what concerns me is they're going to be forced to do it at a time that might not be advantageous for the rest of the stock market.
Right.
If that makes any sense.
It does. It does. And that may put undue pressure. That may put undue pressure because you have so much market cap.
Like what if the stock market starts like puking? Let's look at I like to look at scenarios.
Absolutely. Let's do it.
Let's say oil goes to 100 in August. Okay. And let's say the Nasdaq comes down 10% as that's happening, and interest rates go back above 1.5%. And then let's say people are panicking because oil's at 100 and gasoline prices are like over $4 in most major metropolitan cities, $5.50, $6 in California, New York City, places like that. All over, it's like the headline story of the media every single night on NBC News, ABC News, right? You've got a stock market that's already in a precarious situation. You've got this public outlash, and then they're going to stop buying. They're going to stop flooding liquidity. Like, what happens then? You started a 10% move in a NASDAQ. You don't think that could, evolve into a 25% correction? I do. So that's my problem. I think they'd be better off getting ahead of this thing,
right,
rather than being it's kind of like if you're a portfolio manager and you're in a bad position, and then the head PM at a hedge fund or a mutual fund or something comes to you and says, okay, Jeff, you've been sitting in this position. You've been sitting in this ARK trade for 25% for 20% in your face. Now you have to sell. And, I'm a big holder and I might pressure it down. Then I'm going to lose an extra 10, 15% just trading out. It would have been better at 15% loss if I just been disciplined and said, you know what, here, I made a mistake. This trade's not working. It's time to move on.
Well, it wouldn't
survival and calamity.
Right. And panic and being and making a decision in a vulnerable position where you're just being taken advantage of at every given step.
But we have a Fed governor that I feel that's going to be forced to make a panic. He's going to make a panic trade at the worst time possible because he doesn't realize that there's ways to get out of it now.
You mean like he did about a year and a half ago when he started lowering rates and putting us to the back against the wall before any major market movement began, and where the interest rate market just simply didn't react to it the last two times he did it? You mean like that?
Like that. Another question: why are you guys buying mortgage bonds? We have the tightest housing market in the history of the United States. Why are you buying mortgage bonds every month?
Yeah, it completely counterintuitive. But let me talk to you a little bit about the housing market, because you brought up you're bringing up a lot of topics that I wanted to ask you ahead of time on this talk. This is good.
I came in hot.
You definitely came in hot. And then I love that lamp behind you. It looks really cool. It looks like you're in a nice little woodsy cabin or something.
It is cabin. It's a cabinist thing.
Cool.
Yeah.
So housing market, a few things I want to tell you. And I'm not going to leave things to mystery. This is not a guessing game. So I'll tell you exactly what I'm looking at. As you know, lumber prices have dropped exponentially over the last couple of months. I mean, they've been going down, which I'm very happy about on a personal level, but that's not here nor there.
Sure.
So I started looking at some home stocks, KB Homes, Leonard Homes, the big ones, the real big ones. And I started looking at them on a monthly basis. I think you're going to find this very interesting, Jeff. So, and I looked at, the companies that are national, that have their pulse to the ground, that are extremely interest rate sensitive. And I noticed something very interesting when I looked at the monthly chart. I noticed that these companies tend to peak out on the bottom side and the upside. And if you're folks at home, please listen to what I'm saying. I did a lot of research to gauge this data. Over the last 7 housing markets, swings up and down, these home stocks, they peaked out to the bottom and to the upside on a monthly basis. So not like intraday or daily. I mean, we're talking monthly. Anywhere from 18 months to 24 months before the stock market started, before the housing market started moving in the opposite direction.
Huh.
So to summarize all that, they look like they peaked out about, I don't want to give you an exact time because every stock is different and we're looking at monthly time period, but they appear to have peaked out about 2 months ago, a month to 2 months ago.
Interesting.
So again, it doesn't mean anything's going to happen tomorrow, but for the last several housing booms and busts, these stocks have bottomed or topped anywhere from 18 months to 24 months before the actual movement in the economy. So, for example, the last one we had, they peaked out around 2006-ish. And the housing market gave up in 2008. And the time before that, it was like 18 months too. And then, so I went seven times. And I didn't just look at one stock. I looked at about 4 or 5. Now, that doesn't necessarily go against what you and I have been saying. We weren't saying that the housing market's going to stay hot for the next 20 years. But we were talking like last 6 months, last 8 months, last year, year and a half. What do you think about? Does that fit? If you did not have that analysis, would that fit the economic plan and the macroeconomic plan that you see on the table, or is that off what you're seeing, expecting, thinking about?
It makes a lot of sense, but again, we're at a historic tightness in the housing market, and we've had a secular shift in how people live away from city centers and to second-tier cities. And I don't think that's a trend that's transitory. I think that's a trend that's real. So there's a couple of different things that go into play with that that don't make it as clear cut. Another aspect of it is I was just looking at Lennar, for instance. Lennar is growing the revenues at almost 40%, and they're trading at an 8 PE.
Crazy, right? Crazy.
Right. They did peak, but this is cheap stock with tremendous momentum. And you're in a stock market full of stocks that are like 45 PE for boring old companies, man.
Yeah.
I mean, I'm looking at like Pepsi trading at a 40 PE, like these kind of companies. So I don't know. I can't get secularly bearish on something like that based on those factors, but I could see where you could have a cooling off period for a little while.
And again, this isn't carved in stone. It's not like 99 out of 100 times. We're talking recent history.
We're talking through these ideas, right?
Of course. And you're absolutely right. Things are very different. We are in unprecedented times. And we also have very interesting positioning of interest rates being ultra low, which is also artificial in light of the housing market too. So it's kind of like
an example. I'm visiting this Hilton Head Island, which is a resort town. It's in Low Country, South Carolina. All I see are New York and New Jersey license plates everywhere. And I was playing golf. I was talking to this dude, and he's like, "Yeah, we flipped out of our apartment, and we're looking to build a place right across in Bluffton, which is a town right across the inlet." And a lot of people are doing that, and that's where the housing builders come in. They're not building houses in downtown San Francisco. They're building houses in all these places where people can now live, where they'll want to remote work from. And I really don't think that, it comes back to something you and I have been talking about since the dawn of time. No, since the beginning of COVID. Remote work is here to stay. There's certain aspects of life that have been shifted that will not shift back.
Right.
They will not.
Well, they were going there to begin with. We just kind of pushed it a little.
They were going there to begin with. And like, look, Goldman Sachs, it's funny. Goldman Sachs just had a massive beat. They crushed, and they did it from home. Like 50% of their company still working at their house. So how can they, like, in good faith, tell all these guys that just had like earth-shattering earnings, you have to come back and sit in front of me at a desk?
As I mentioned to you, I'm here with some relatives that live in Boston, and one of them is a executive at a major pharma company, major, like one of the top pharma companies. He oversees 200 people working from home, completely working from home. That's some serious business we're talking about.
Yeah.
So yeah. It's that I agree with you 100%. I mean, home prices in Austin, Texas are bidding $300,000 over market value right now. $300,000.
There's so many dislocations in the economy, like used car. I mean,
Google, Jeff, I didn't
go on Kelley Blue Book and put your car in. It's going to be worth more than it was new. You're going to be shocked.
Let me tell you this:
miles on it.
We don't have to go that far. So 9 years ago, I bought a Jeep, a 4-door silver Jeep. It was like a second, third car that I just had like for fun. That it was like if one of my cars went bad and so forth. So I kept it and I gave it to my son when he turned 16, and he's been driving it for 3 years now. And he's in Gainesville. He's in UF. So I wanted to get him something a little safer so the car only has 40,000 miles on it. So I traded it in for a different car. I bought the car new 9 years ago, Jeff, for $33,000 or $34,000. Guess how much I sold the car to 𝗧𝗴𝗀 for, who wrote me a check without seeing the car and picked it up and gave me 1,000 extra miles on it.
40,000 miles on it?
44,000 miles on it.
20,
Good condition.
25,000.
$26,500.
Not bad. I said 25. That's still wild. The car should be like 15,000. It should be like 15. That should be the number. Isn't it crazy?
Imagine
work. We have like this like calculators depreciating.
Yeah.
My wife hates that. She's like,
yeah, 15. Yeah. The fair value is like 15 to 17,000.
Yeah.
And I got
9 years old.
$26,500 for that car. And about 30 companies begging me to sell it to them. And I asked 𝗧𝗴𝗀, I'm like, how are you guys doing it? And they said that they're selling these cars to rent-a-car places, because rent-a-car places need cars right now because there's so much demand for summer travel and so much rent-a-cars. We were at the airport here. People who didn't rent their car 3 months ago are paying like $200-300 a day to rent a car right now.
Well, you know what happened? Well, when COVID struck, to stay in business, they sold off their fleet. They reduced their inventory at the worst time. It's amazing how bad corporates do it. I mean, they had to. It was life or death. Like they had to keep their payroll going. They sold cars. They have cars that were sitting and they sold them, and now they need cars and they can't find them.
Yeah, but anyway, I wanted to share. I don't get too personal here, and I know you either. But I just had to share this with you because it was one of those stories. You know, you can't make stuff like that up.
And listen, man, there needs to be there's an inflection point coming. There needs to be a boom or bust or both to this entire cycle. It has to happen.
Yeah,
it's untenable that it goes on like this forever.
Yeah.
It's untenable.
It's just we're overstretched. The market we are in a confused environment, and the Fed is just doing everything to just keep. And again, if they just said, look, folks, let's just time out. Let's just take 10 minutes. Let's be real. Yeah, it would cause a big havoc for the market, but at least we wouldn't be living in Disneyland.
But again, they're looking at stocks that are like the market's still at all-time highs, right? So let's say they came out and said, you know what, starting in September, we're going to reduce by X amount. Maybe not the full Monty, but we're going to reduce it by 25% our purchases, or we're going to reduce mortgage purchases by 50%. You're going to get a hit in the stock market, but I guarantee that there's going to be buyers there, because there are specifically for good companies. There are, and that'll create that next leg higher. But the more like what's happening with lumber, boys and girls at home, is purely a result of asset price parabolic insanity. If it didn't have the move on the upside it wouldn't have had the collapse it had. It's going to settle in somewhere a little bit higher from here, I would bet, in the next months.
Yeah.
But because it tripled, it was an extraordinary move. It went from $500 to $1,500, and now it's back down to $600. Because it tripled in such a short period of time, it's having the move that it's happening. You see the same type of thing in meme stocks. Meme stocks, because they have such extraordinary moves, the fallout is always extraordinary. And so asset price action is very important, and they don't consider these things.
No, and what I'm afraid of is what you just described happening in the lumber market. I'm afraid of that happening in the stock market to a lesser degree. But
I know.
That's what
the meme stocks are starting to fade, right?
Yes, they are. That's another. That's another. Yeah, that's a totally different. But they are. There's a lot less news about that, and I think that has a lot to do with the fact that we're in earnings, and there's a shift of focus right now.
I think the Robinhood IPO is going to be the top of it. It's going to be the end of it. Yeah,
you know what? You're probably right. That probably will be it. Before we conclude, I want to ask you a few things. We just started earnings season. Do you see any particular surprises, any good or bad in any particular sector? Anything you're looking at? Anything you want to advise people at home about?
I had a thought this morning that came to mind, and about cars. Let me talk about autos. There's no cars. They're not selling cars. So be very careful long any automakers right now, because they're just not selling cars. They're not making money. And so they're priced I don't think that the estimates are reflecting the real lack of activity in that, and then Tesla is included in that. So be careful. Be careful.
It's definitely a very, very interesting time. Very, very interesting time. Do you think the earnings the end of the year earnings estimates on the Nasdaq large cap stocks are going to have an impact in terms of bond prices and bonds, or do you think that's already kind of priced into the market?
I think earnings are priced into. I think earnings are priced into the market. I think bonds just reflect that what's the word I'm looking for? Relative valuation thing with the stocks, right? If you look at stocks with decent yields and then you look at these bonds that don't have growth and they just give you this weak yield,
Do you think the Fed is going to take action in late August, September?
Yes, I think they're going to be forced to.
Yeah, me as well.
I think this oil move, I think there's going to be an oil move, a gas move. There's going to be a reflation move that happens this summer that's going to force their hand. Sadly, I think the stock market's going to already be in a precarious situation because I think I'm giving you my whole playbook right now because I think this earnings season is going to come out lukewarm. And I think stocks that make or slightly miss are going to get crucified. And I think if you looked at Goldman yesterday, they crushed. I mean, they smoked it and the stock traded lower. And so that is a sign that the market is already at peak earnings and stocks do worse. Stocks do worse after peak earnings are priced in.
There's just too much good already priced in, and it's just too overwhelmingly optimistic.
Gun to the head. We come out of this earnings season with the indices lower, and inflation back up, and commodities back on the rise, and the Fed forced to act, and you can see the rest of the fall. Fall's always a violent time, so I expect a very violent fall in 2020.
Right. Boy, you and I are seeing things very, very similarly, Jeff. I'm seeing very much the same thing. Yeah. Folks, this was a wonderful, wonderful session. Folks at home, if you want to reach out to Jeff, and please do, neither of us bite. We're not bears. We don't bite, even though we're near cabins. Have you seen any bears where you're at?
No, I've seen a lot of alligators though.
Oh, okay. Interesting. Yeah, there's a lot of alligators in Hilton Head. So anyways, if you'd like to reach out to Jeff, if you want to ask him a question, please do. Jeff@joyofthetrade.com. My email, support@marketgeeks.com. That's Jeff@joyofthetrade.com and support@marketgeeks.com. We had a wonderful session as usual. Jeff, I hope you have a wonderful, wonderful time at Hilton Head, and I will catch you next week and probably earlier because you and I do speak sometimes.
Yeah, we do. I'll see you next week. Thank you, Roger.
Thanks, bud. Thanks for your time. Have a good one. Bye.
Bye-bye.